Welcome to Finance This, Property That. My name's Dion Fernandez, and this podcast is for property enthusiasts, time-poor professionals, self-employed borrowers, and strategic investors looking for residential or commercial property who want more than just a low interest rate. They want a strategy and a team around them. Each week, I'll share strategies, structures, and lending moves that actually grow wealth, not just get you the loan. And also, I will help you surround yourself with information from professionals in their field. If you're here to build smart, not slow, you're in the right place. My vision is to empower financial legacies for generations. I am a mortgage planner and finance strategist, and I work with doctors, developers, business owners, and high-income earners to build serious property portfolios. So without further ado, let's get into today's episode. Hey everybody, welcome to this episode of Finance This, Property That. Today, I want to cover off a really hot topic. It's one I do a lot of, is around trust lending and basically how the wealthy actually buy property without killing their capacity. So today, we're going to unpack trust lending and why is it powerful, but also why most people use it, what are some of the issues and where they get stuck and how they and why some of them actually use it incorrectly and who should be using it and when. So there's a difference between setting up a trust and for strategic purposes versus the reactive use. And we'll cover off on a few things like that today. Like I said, I do a lot of trust lending. It's how we build out portfolios for clients, and it's a really good way to not kill your borrowing capacity when used correctly. So why do clients use trusts or get advice to use trusts? Well, there's a few reasons. Firstly, it's around asset protection and protecting your borrowing power. So usually the asset protection piece comes from your employment. Are you a director of a company? Are you in a high-risk job like you're a brain surgeon or something along the lines of that? And that protects the asset from it's out of your personal pool, it goes into a non-personal pool. How does it protect your borrowing power? Well, the borrowing power is protected when the banks can see that the trust has its ability to service the debt within its own structure. Now, each bank has different rules on that. I'll touch base later on what lenders actually do trust lending well. But it'll really come down to policy and how you set up the trust itself. That's how you set up the borrowing power. That's how you silo the borrowing power. The other thing it does, it separates the personal and investment risk. So, a lot of the standard structure would be around, you own your owner-occupied and maybe one investment property in your personal name to give you, a bit of tax deduction on that investment property. And then as you're trying to build it out, you'll eventually put it into trust. So you're separating that personal tax versus the investment tax as well. And then you're also giving yourself a bit of asset protection in that piece as well. The other thing it offers you is around income distribution flexibility. So and there's also a bit of tax effective structures that you can talk to your accountants around. We're generally in a trust. If you make a profit, it usually has to be distributed somewhere, either to you personally or potentially to a bucket company to do further investments. Again, those structures you need to talk to your accountant around. And the other thing that I really like about trust lending is that it allows you estate planning flexibility. So what that means is within a trust, you can set up who the beneficiaries are and who receives the assets within the trust, and you can plan forward around your estate for when you are eventually not here. Again, for that, you'd be speaking to a financial planner, someone like like Troyden from Willow Wealth Partners, and an accountant, someone like Morgan from Credit or Meg from Third Space HQ. They've all been on my podcast before, so hit them up as well. So what actually goes wrong? So where do most brokers, and I'm calling it out, most brokers, bankers and investors, where do they get this wrong? So here's a few places. So most bankers let's talk with if you're going directly to your bank, I say this all the time, you're only going to get one policy, one product, and you may not get an experienced banker or personal lender there that understands how to do these structures, and it'll actually delay your purchase, and it'll actually may end up costing you more, not just financially, but also opportunity cost to get in the market. Where brokers normally get this wrong, or is around maybe more so the lack of understanding. Most brokers don't like to do trust lending. It's sometimes too hard, but really it's not. It's just about the mindset and how you educate and understand the policies behind it. I personally love trust lending because my specialty is around debt structure and strategy, and I just have that extra level of expertise around it. I've been around it for a long time, so I understand how to set it up and early, not late, and also which lenders know do trust lending well and what the policies are. You as a borrower or a purchaser, you quite possibly are not asking the right questions of your accountant. So you usually will have a tax planning session. If you've got a few properties or you're running your own business, or you're making quite a bit of money, you usually have a tax planning session with your accountant. Now, if your accountant doesn't know whether you want to borrow next year or you haven't disclosed that or anything like that, you probably doing yourself a disservice not being prepared for that meeting. And I would encourage you to, when you're doing this time of year, May, June, July, August, you're planning your tax and things like that as well, because you're better off setting up a trust strategically rather than reactively, where it has to be slapped together. It may cost more, mistakes can be done. Also, a lot of bankers and brokers, don't understand that sometimes servicing in a trust is different. There are a few key things you can't use in a trust that you can only use in personal lending. One of those things is negative gearing. Now, there is an asterisk around that. Some banks will allow negative gearing inside a trust, but that's a policy that we'd have to research whether that lender is a good fit for your current requirements. But usually the trusts will have to, you can just use the rental income in the trust. There's no gearing or anything like that. And also then it would use your personal income that you declare, whether you're PAYG or self-employed. So trust lending, you do have a lower servicing threshold because of the you can't add back the negative gearing side of it. The other thing that you as a buyer or a person that uses a trust to purchase property, you probably look at the cost of setting it up and forget about the opportunity cost. So when I say setting it up, so there's a few different ways, and I'm going to go into the different ways you can set up a trust or that I've seen. The cost of setting one up, there is a cost to set it up because there's a trust deed. You may have to set up a company, then there's directors costs and things like that as well. So generally, if you're setting it up in a corporate structure with a corporate trustee as trustee for a trust, there'll usually be more costs. But what you're probably not looking at is also the ongoing cost of the tax return, but then you forget about the opportunity cost. What that means is the capital growth that property is potentially earning you is far greater than the cost you've actually paid to set it up and to keep the trust ongoing for the tax purposes and when you're running your taxation. So have a little think about that. Also, when you are lending in a trust, you do have to get independent legal advice and sometimes independent financial advice, depending on the structure and who's borrowing and who the guarantors are. And again, it depends on the lender as well. So every time you borrow, it is a cost. Every time you purchase another property, my suggestion is mostly get another trust so you're siloing off the investments and they're not interlinked. But again, there's a cost to doing that. But what's the cost of doing that versus the cost of the growth in the property? So what are the different types of trusts that the banks look at? Well, the most common type of trust is the discretionary trust. Normally, the types of clients I deal with will set up a company. Let's say it's husband and wife. They'll be the directors of the company. And what I probably suggest, depending on how many lenders you want to use, they should be the shareholders of the trustee company, and the shares should be beneficially held. Now, you can change that later on. However, there are some lenders that will not lend to a company trust structure where the shares are not individually and beneficially held. When there are some that will, but the rates are different and the cost of doing that's different as well. There are unit trusts and hybrid trusts. Look, these are rare and obviously often misunderstood by the lenders. Sometimes they don't like it because you've got to trace back, who the ultimate beneficial shareholders are, etc. And they don't want any third-party shareholders inside it. So again, if you're looking at setting up unit trusts and things like that, you can speak to your broker first, and because the research will dictate, or the policies will dictate, whether you can or cannot. I recently did one and did a purchase in a unit trust. It went quite smoothly, but it limited the amount of lenders that I could go to because of who the trustees were. Brings me to my last type of trust you can do. Very, very common at the moment and very popular is around the self-managed super fund trust. Now, this is probably the most expensive type of trust setup, but also has its advantages. It has its pros and cons. The self-managed super fund is a trust within its own. You're actually transferring your retail super fund balances into the self-managed super fund, and that's where you're doing all your investments. But in order to purchase inside a self-managed super fund, because it's limited recourse lending, you actually need to create another trust called a bear trust. And that will purchase the property, and the self-managed super fund will do all the lending, and it's got no recourse back to the self-managed super fund. However, once you pay off the debt and want to then put it back in your self-managed super fund's name on the title, you will have to pay title fees. But the self-managed super fund has a lot more expenses because you've got to audit it. You also have to run the financials and the tax side of it as well. So be really careful. You should be getting the advice from a financial planner and an accountant before you go do one of those. So what documents do you require? Well, I just touched base on that. If it's a trust, you're going to need the trust deed fully executed, which means it's signed by all parties and dated. If you've made any amendments to the trust, we need all the amendments, fully executed, signed and dated. I usually will get, if it's a corporate trustee, I'll usually get the trustee, the ASIC search to tell me who the directors and shareholders are. That'll come straight from the accountant. So that's generally a gist of what it is. Some lenders may actually ask for the financials of the trust entity if it's been a few years and it's been running a rental property. The one thing I will say is, as a general rule of thumb, lenders will not lend to a trading entity, which means that if you're running a business in that trust, i.e. a mortgage broking business, and you're purchasing property in that same trust, they will not lend to it. As a general rule of thumb, the way to get around that is just open another trust, speak to your accountant, make sure it's the right fit. We don't want to muddy the waters there. So let me just run you through a quick case study of a medical professional that we just helped recently. So they already had 2 properties in their personal name, so owner-occupied, and their first investment. They were stuck at their bank. The bank had cross-collateralized all their loans, and they were also capped with their current lender as to what they could do next or how many properties they could do next. So we sat down, worked through their current debt structure, looked at uncrossing all their loans, releasing some equity, and then purchasing the next 2 properties under separate trusts. Both have individual corporate trustees. They're both the directors. They're both the individual shareholders beneficially held. And also they told me they're in the middle of setting up their SMSF anyway. So we tacked on the SMSF as well. So basically what's happened in the last 5 months, we've actually purchased and settled on their first trust investment, purchased and settled on their first SMSF, and they've just signed a contract to purchase under their second trust. And this property's a bit diversified because it'll have commercial and residential. It's a mixed use property, which is awesome because it diversifies their portfolio as well and increases their cash flow exponentially. And all of this was done in 5 months because we prepared for it. They have all their trusts set up in the way they wanted it done so they could go make the offer on the second property. The SMSF was already being done. We already told them about the Bear Trust, and it was just easy for them. Also, we selected lenders that were very trust friendly. And that's really important because there's lenders, some of the lenders, especially in the major banks, they want to do trust lending, but it'll come at a cost. The cost is usually the setup costs and also the rate. They will sometimes load the rate because they deem it as complex lending. It's really not complex lending. It's just about the structure that it comes in. So again, there may be a lack of knowledge in the credit assessment team, which means that it's really important that you have a broker like myself that understands how to present the deal so that it's understandable for all the credit officers to read and you'll get the best outcome. So some big takeaways that I'd encourage you if you're looking at setting up a trust structure. Firstly, speak to a broker and talk about your big picture and how do you expand your portfolio. Then make sure it aligns with your accountant. You speak to your accountant and financial planner if you've got one, and make sure that it is correct for your tax strategy. Also, set your trust structures up before you apply. If you know you're going to have 2 trusts, you want to purchase in 2 because of our strategy, set up 2 that you're ready to go. The lender that is chosen should be based on structure fit and not rate. If you're chasing rate and you're trying to do stuff in trust, you may be in for a rude shock. And more importantly, I'm going to come back to it because I've said it before, work with a broker that understands how to lend under trust, because they'll know how to structure your deal and send it to the right bank so we're not wasting time and we're getting the quickest approvals. So, thanks for listening. The information on the show is very general in nature, doesn't take into consideration your personal circumstances. If you are thinking about lending in a trust and unsure, or you want to expand your portfolio, come speak to me directly. We can talk about your personal circumstances directly. You can find me on Instagram at Dion Finance Specialist, on LinkedIn, Dion Fernandez, and the podcast website, www.financethispropertythat.com.au. Like, follow, subscribe, tell your friends. If you found this useful, don't keep me a secret. But until next time, see you on the next episode.